from the session that we had last week, we asked, we sent a link out, and we asked for people to go through, come back with some feedback, and we're going to pick up some people who would be able to present. So I'm going to give the floor to Anjola Oluwabusari to very quickly, within a minute or thereabouts, give the view as to what she learned on the link that I sent you. So Angela, you have the floor.
Okay. Get out first.
Okay, go on.
I have learned that one should use their money responsibly by investing in properties, people, or businesses with promising futures. One should also place some of their money in an emergency bank account, where it should only be accessed in case of an emergency. I have also learned that one is allowed to treat oneself once in a while, but should never spend more of their money foolishly by taking more out than they have in. And finally, one should have a steady source of income, regardless the amount of money in their bank account, as anything can happen to their money.
Okay. Thank you. That was a very good summary. Thank you. So let me go on to, and I'll come back to maybe making some comments towards the end if we have time. Let me go to Adeshola Busari. You can give us your summary of what you learned last week.
Okay, so I said that Carol's story is a perfect example in how, without having a balanced relationship of both money and education, the main objective of earning money to free up time becomes lost.
Sorry, Deshola, your mic is sort of going. So can you move closer to the microphone so we can all hear you very well?
Okay.
All right, thank you.
Is it fine now?
It's much better, yeah, thank you.
Okay. Carol's story is a perfect example in how, without having a balanced relationship of both money and education, the main objective of earning money to free up time becomes lost, and instead we can end up wasting money. From this story, I can see that Carol did not realize that when it comes to money, it is not about how much you make, but more about what you're going to do with it. I feel like as he had received such high earnings, and that since he wasn't even able to put it into a bank due to his criminal record, he felt lost in his wealth and became reckless, which is what led him to losing thousands and hundreds on drugs, parties, jewelries, and cars, instead of investing that surplus into assets. He also made the mistake of flaunting his wealth, which is what encouraged blackmailers to fork out the 130,000 from him. This could have been far less likely to happen if he kept his financial business to himself. On a more positive note, however, I've learned that the one thing that did save him was the 3.9 million investment bond he set up to generate monthly income. By doing this, he allowed his money to work for him, so that while living off this bond, he did not fall into serious financial debt later on in his life.
Thank you. Thanks a lot. That was quite a good summary, actually. Thank you. And there's a few keywords I would pick up from that towards the end of today's session. Over to you now, Crystal Maduka. Is Crystal on the call? Okay, while we're waiting for Crystal, let's go to Romeo, please. Romeo Bremer.
After reading the text about my
Hello, Romeo. We can hear you.
After reading the text about Michael Carroll.
Sorry, can't hear you very well. You need to move closer to the microphone.
Hear me now?
Yeah, we can hear you now, yes.
After reading the text about Michael Carroll,
yeah,
the first thing I learned was to not spend my money immediately. This means to be wise with my money, or if I have to spend my money, invest it. This could mean invest in smaller companies, properties, or shares. If I decide to spend my money, I should always think long term, like Michael Carroll did, and buy a house. I should gain loads of assets and try to lower my liabilities. However, it is important for me to save and budget my money every month. At the same time, if I'm sensible, I can treat the ones I love.
Thank you so much. That is really, really good, actually. I like some real key things there. Being sensible, spending money wisely, investment. Is Crystal available now? Okay, it focused on the core of what most of you have asked me to do for you, which is really to talk about investment. And therefore, we don't have that much time. I really want to keep to about 45 minutes max. And then, towards the end, if we have about 5 minutes to ask questions, 5-10 minutes, I'm very happy for us to do that. So let me start. I will be presenting now, and then hopefully you can see the slides much better. Okay, so the first thing I'd like us to bear in mind is money is like muscles. It's like when you go to the gym and you exercise, you don't see the result. Not necessarily, you don't see the result like within a week. It's a gradual process. You go to the gym every so often. So long as you're constant in your thinking and you're doing, then gradually you build the muscles. That's exactly how money grows. So money is like muscles. Know when and how to exercise it, and it grows steadily. Okay. So the first thing is to teach you or to go through the components of what I call financial literacy. And what I like about some of the stuff that I've heard from the speakers earlier on, which I find really, really useful, is that they seem to have picked up some of the terms that I'm going to talk to you about. But effectively, financial literacy is broken or can be broken into two parts. One is the knowledge that you need to acquire. The other one is the skills that you need to acquire. So in terms of knowledge, what do I mean? It's an understanding of the core concept of personal finance. Yeah, what you need to know when they talk about interest rates, credit scores, when we talk about emergency fund, all of those things. When you understand those things, then that is knowledge for you. Now, skills is slightly different. When you have the knowledge, what you then need to do is you need to complement that knowledge with the ability to actually do something about the knowledge that you have. So things like knowing how to bank and use an online app, knowing how to secure your passwords, knowing how to borrow money, knowing how to spend money, that is a skill. So the first thing is the knowledge, the other one is the skills. Okay, so the particular knowledge and skills that define financial literacy can be divided into 6 categories. So the first one is spending and saving. I think most of you have a good understanding of spending and saving. The other one is income. Now, income is money that you as an individual or somebody or a business receives. Usually, it's in exchange for your time, which is service, or something you've sold, which is goods. Or sometimes income comes through investment. So if you invest in something and there is an interest on top of that, then that's income as well. We'll talk more about income later on. Then there's credit and debts. We spoke about that last week. I'm going to speak a little bit more about it this week. There's employment. There's investing. Then there's risk management, and then there's decision making. Risk management I will talk on slightly a bit further because it's good to have a sense of perception of risk, but you need to be able to manage the risk so that it doesn't become fear that stops you in terms of investing. Okay, so sorry, I'm trying to see why this is not okay. There's a concept I want to deposit in your minds at this point in time, which is that of prudence. Prudence is a virtue. Basically, what it means is the ability to govern and discipline yourself by the use of reason. So it's just basically not going out and doing silly things. It's a skill that you acquire and a good judgment in the use of resources. So all of what you're going to learn today is really going to be largely based on prudence, and I'll explain to you why. The case study I asked you to go and think about last week, and the 3 speakers that spoke, a lot of them talked about the fact that Michael Carroll didn't really manage the money properly. Now, one of the biggest skills that you will develop in managing money is prudence. It's how not to be foolish with money. So we're going to touch on that very, very quickly as well. So the whole essence of investment is about, it's not like a fast lane thing. You know, I want to make money next week. I want to make money next month or next year. That always gets people into trouble. So please, especially as young people, I want you to develop an investment mind, which is medium to long term. Okay, so grow rich slowly. Set realistic short and long term financial goals. It's not like I want to have £100,000, or you're starting. Okay, someone's asked a question. What is financial literacy? So literacy is basically knowledge. So when I say financial literacy, I'm talking about financial knowledge. Okay, Davina, do you understand that? Okay, so in effect, set yourself realistic short and long-term financial goals, and then as you go forward in life, what you do is you try and see whether you have actually achieved those goals or not. Okay, Mrs. Amole, I'm going to come to that later, not now. Okay, so going to the next one, which is, so develop a written budget and review it every month. This is one thing, even myself, I've developed as a habit. I do this every month. Always save 50% of any salary increase you get. So most of you are not working now, but you actually, maybe some of you get pocket monies. Every pocket money that you get, don't think about spending everything at once. Always try and save about 50% of that. So I'm not going to go through most of these, but I'm going to share these slides with you all when we finish. So the key one I'm going to point out here is try and have a discount mentality. What I mean by that is, when you go into a shop, and this is going to sound very, very funny to most of you guys, because you're very young people. You think your parents may embarrass you, but my kids know how, you know, it's not embarrassing, but my kids know that by now. When I go into a place, if I want to buy a car, for example, I will ask for a discount. If I go into a place, there's nothing wrong in asking for a discount, or is this the last price? That is called negotiating. Don't be seen as, oh, you are cheapskate. No, it's not. It's called negotiating. So try and always find a way to negotiate a better price. Okay. The next one is, the other one I'm going to pick up there is, try to be unique and be an individual. Don't be a label, and don't try to keep up with the Joneses. Oh, my friends are wearing this, my friends are doing this, they're eating this, and therefore I want to be like that. Try and be yourself. That's one of the biggest things you're going to really understand as a person. I wish I could teach you more about that. And that is part of prudence. It's got to be something that's in your psyche, that you wake up every morning and you sleep every evening with, this is who I am. I'm not trying to be anybody. Don't try and be like the Joneses. Before you buy anything expensive, stop. Ask yourself, do you really need it? Okay, you're supposed to buy the things you need and wait to buy the things you want until you can afford to make the purchase. So I'm going to share these slides. I don't want to go through all of this in line by line. If you don't understand anything, please stop me and I'll try and explain to you, or send me a message on the on chat. So the next slide, okay, so is really about, this is the core of the message I'm going to give you today. Okay, the secrets of making money, growing money, and keeping money. So on this one, I'm going to try and spend probably about 15 minutes. If you don't understand any part of this bit that I'm going to explain to you, please just stop me and ask me, so we don't waste our time. Okay, what's the secrets of making money? Making money is basically either you exchange your time for money, or you have an asset that is working for you to make money. When you exchange your time for money, it's mainly income, it's mainly salary, either as an employee, or in some instances, it's basically you're running a business. So that's work. So the formula for making money is work or assets. If you have assets, and that is why, last week I asked you a question between what is an asset and what's a liability. An asset is something that works for you and makes you money, or has a potential of making you money. So if you, for example, buy a property, you buy a house or you buy a flat and you're renting that flat out, that flat is making you money, okay, or can make you money. If you maybe invest in a vehicle that is used for Uber or Uber Eats or whatever it is, and you rent it out to people who do Uber, that is not buying a car as a liability so that it is depreciating an asset. That is buying a car as an investment, because that car is making you money, okay? Now, the secret to growing money is savings and investment. Okay, so the first thing you got to do is you got to make money, either through working or business or through assets. The second thing you do is you grow your money through savings and investments. We're going to spend a lot of time on the types of investment and how you invest as well. The third one, which is around how you keep money. Okay, keeping money is far more important because this is what defines your character as a person. It doesn't matter how much money you make. Please bear this in mind. It doesn't matter how much money you make. It doesn't matter how much you make in interest from your investment. If you cannot develop the character and the habits to keep money, which is basically spend less than you make. That is the principle of anybody that wants to grow money, anybody that wants to be seen later in life to have been able to not be working when they're 70 years old. There are people who have learned the habits. And you remember last week we did habits. That's why I did habits last week. There are people who have developed the habit of spending less than they earn so that what is left, they then invest to work for them. Okay? So those are the key principles of those three things: making money, growing money, and keeping money. Right. So generally, like I said, you make money through the work that you do, either business, employment, or through an asset. You have a house, a car that is rented out. Does anybody else know what maybe might constitute an investment? You can send it to me in a chat and I'll read it out. So through an asset, you may choose to invest, or sometimes stock and bonds. I'll go through stock and bonds later on, what they mean. So when you invest, the intention is to make more money than the money that you've invested. So please follow me. If your mom gives you, let's say, £1,000, so you're very lucky, you've done very well this year, and mommy and daddy says, here is £1,000. And you now, haven't gone through this training, become very prudent, and you decide to develop a habit of savings and investment. You might say to yourself, well, actually, do I need to spend this money? If you say, I'm not going to spend this money, you can then say, okay, look, I am going to invest this money. I'm going to invest £1,000. So the moment where you make that decision that you're going to invest that £1,000, that £1,000 therefore becomes what we call a capital. Okay, so the money that you are investing is called capital. Now, let's say you now invest the money. Let's say you buy. Somebody has taught you how to deal in shares, or maybe somebody says, if you put this money in this place, I'll give you £100 as profit, or as on top of that, on top of that £1,000. When you do that, that £100 that you have made on top of that £1,000 is called profit. Or that is your profit. So £1,000 is the capital, £100 is the profit. So when you're talking in terms of financial terms, you would say that the interest that I've made on my capital is 10%, because £100 is 10% of 1,000. Does that make sense? If you understand, you can give me a show of hands. Now there are some other. Thank you, Angela. There's some other terms that you will hear, in terms of financial, in the financial environment. And what I've done is I've actually put together a catalog of financial words and their meaning, which I will send through to the administrator. They will share with you so that you can begin to learn these things. One of the things you will hear is yield. What is a yield? So in the example that I gave before, where they said your mommy and daddy gave you £1,000, you've now chosen to invest £1,000, and you've made £100 profit from your £1,000. Now, assuming that you made that £100 profit within a year, that means that your yield is 10% per annum. Okay, your yield is 10% per annum. So when you do a 10% yield per annum, in the following year, you might actually reinvest that £1,000, but maybe this time, instead of £100, you're making £200 return on that £1,000. That year, your yield is 200%, is 20%. So, Precious wants to find out what is an asset. Precious, just take it easy. I have a definition, so that don't worry. The next slide will explain asset and all that stuff to you. So I'm going to come down to that. Davina, money can be an asset, but asset is broader than money. Okay, so I'll explain asset very soon. So the things that I've just introduced to you is work, assets, savings and investment, and spending. Excuse me. Thank you. So go to the next slide. I think so. One of the things that you need to do before you even start on your journey to investing is you have to ask yourself the question, why do I want to invest? Having a wealth plan or investment plan is very, very important. I wish at your age I had gone through a class like this and I have developed an investment plan, because the best time to start is now. If you can develop a mindset of, say, I want to retire, or I don't want to go to normal work by the time I'm 40, I want to be able to free up my time so that I can do what I want to do, not what I need to do in terms of work. Then you can say, okay, I'm going to have, I think the average age of everyone that we have on here is around about sort of 15, between 15 and 18. So if you want to have a plan to say you're going to retire from active work when you're 40, that means you have, give or take, a 22-year investment plan, okay? And what you can do is you then ask yourself, what do I need? How much is enough for me when I'm 40? £1 million, maybe £2 million. So that is what an investment plan does for you. I will share an example of an investment plan with you, which the administrator can share with, can give to you. So effectively, a wealth plan is something where you say, you know, when do I want to retire? How much do you need? When and how much is enough? This, therefore, will inform your decision as to what you invest in and how you invest, okay? So that is why a plan is essential. A plan is something that you can always go back and refer to say, am I hitting my targets? Because if you want to make £1 million by the time you're 40, you have to then work backwards. How much do I need to start putting aside now? What are the kind of investment classes? What are the kind of investments I can make now that is going to give me £1 million by the time I'm 40? And that's why I said you must have, especially at this age, you must have a very good, broad mind about investing in the medium to long term, not necessarily about making £1 million next year or the year after. Okay, so, and I've said on here that if, I don't know if any of you have heard this saying before. They say a fool and his money are soon departed. What it is basically when someone is talking to you about investments, as you grow older, you hear a lot about investment. You will hear about people coming to you, bring money, let's invest in this, bring £100, bring £2,000, bring £3,000. A lot of stories, especially when they know you have some disposable income. You have to be very careful. You have to think about your own wealth plan, your own investment plan, and you have to stick to that. Okay. So Precious is saying, what does investment mean? Hang on, Precious, because I said to you that I'm going to explain investment and asset to you. Just give me 2 seconds. Okay. So let me explain Precious's message, because I think it's quite important. Precious, when I said to you that when mommy and daddy maybe gives you £1,000 and you decide to put the money aside, when you invest the money, what you're doing is you are either lending the money to somebody else who wants to use the money to do something to make money, or you have identified an activity that is going to generate more money on top of that money, on top of £1,000. So an investment, or if you use the word term, investment is basically an activity that you employ capital. Remember we talked about capital, that you put money into to generate more money. So if you buy a property, then you have invested in property. Precious, does that make more sense? Do you understand that? Anyone who doesn't understand investment as a definition, please, send me a message. Let me understand that. Then let me answer Precious's question about assets. So last week we talked about assets and liability. So does anyone want to go back and explain what an asset is? Any hands raised? Send me a message Anybody who wants to just send a message in the chat, say you want to explain assets. Nobody? Okay, so let me explain what an asset is. Let me see if there's any hands raised. I don't see any hands raised, so that's fine. Okay, so an asset is something that you basically invest in that makes you money. An asset makes you money. So an asset can be something that is movable or immovable. So I have a further definition of asset down the line, but basically it is something that you put your money into that makes you money. You remember last week we talked about depreciation. We talked about things that can lose you money, liability. So if you buy a car to drive for yourself, we say that is not an asset because that's a liability, because as soon as you take the car out of the garage or the forecourt, it loses money. Therefore, because it's not making you money, it cannot be classified as an asset. However, if you take money and you go and buy a flat to rent to somebody else, a flat is going to keep generating money. Therefore, you have an asset in that property. Okay, Precious. Precious. Is that clearer? Let me know before I move forward. I can't. Thank you, Benjamin. So yeah, so something that works for you to make money. That's an asset. Thank you. Okay, so let me. That's right, Esther. Asset is something that makes you money, and liability is something that takes money from you. Excellent. Thank you. So these are some bullet points I've put together that hopefully when we finish today, you can go back to them and see if they would help you. Basically, be familiar with finance terms. I've put together a table of some words and what they mean, including asset, liability, interest, capital, all of these things. I've put them together into a table. I will share them and I'll give them to Mrs. Omole. She will share them with all of you on the call today. What goes into your account must be bigger than what goes out. We've spoken about that, because for you, Ayanfeoluwa, yes. So if you buy a car and you are going to use it for Uber, so long as the money you're spending on maintaining the car is not more than the amount of money that the Uber services is bringing in, then that is an asset, because that is making you money. Okay. So when you buy a car, as an example, there is things around depreciation. A car doesn't last forever. Yeah, a house can last for a long, long time. So if you buy a car, you have to maintain it, you have to service it, you have to buy petrol, you have to do insurance, you have to do all those things like that. And actually, every year the value of a car actually depreciates, which means it goes down in value. So if you buy a car for £20,000 now, next year that car is not going to be worth £20,000. So even as an asset, it's a very, very difficult thing to classify as an asset. But if the car is making you regular money that you can save and build up into something else that can buy more cars, then it can be classified as an asset. Okay. Okay. Thanks, Ayanfeoluwa. You understand that? That's fine. Emanuela, yes, an asset can potentially lose you money, but I'm going to come back to that, because one of the things that I will teach you is when we talked about the essence of medium to long-term investments. I'm going to come to that, but please pack that and I'll. Can you, just in case I forget, can you make sure that maybe when I finish the third slide, if I have not gone back to this question, Emanuela, please ask that question again. So let me go back into this slide. So effectively, you have to tame your costs. I just explained to you now that even if you buy an asset, and this ties into the question that you're asking, Emanuela, if you own an asset or you buy an asset, one of the things you have to bear in mind is that a lot of these things still require maintenance. So the essence of making money is that what goes in must be more than what goes out. So even if you buy a house, as much as we're saying that a house is an asset, if you buy a house for £10,000 and every year, let's say the tenant that is there is paying you £1,000 a month, if every year you are spending £1,200, yeah, to pay the council tax, to pay whatever it is to do the maintenance in the house, then what it means is that you are actually losing £200 a month on that house. In that case, that house has problems. Either you bought in the wrong place, or it is structural. It has a structural problem, and you need to address those those problems or whatever. So the idea of an investment or an asset, the idea of an asset is an asset must be something that when you go in with your eyes open, okay, you should make sure that you understand the risks that are in buying the assets. And that is the question, Emanuela. The answer is that yes, an asset can potentially lose you money, but if it's a trend, you know, in the UK at the moment, but globally, we're going through a very difficult time financially. So one of the things might be that maybe you bought a house at £10,000, and the economy overall, not just in the area that you bought the house, but the economy overall is so difficult that the value of the house has come down. One of the things that you do as an investor is that you take a medium to long-term view of the market or of that property, because you know that because it's a property, the chances of it increasing in value is very high. So it might be that a property will give you a monthly rent. You continue to collect the monthly rent because that is income, with a view to say maybe in 10 years time you're going to sell that house and you're going to make a lot more money when you sell the house. Okay. Very quickly, don't buy at first point. Use your head, not your heart, when you buy things. Pay your debts at every possible opportunity. Let me just give you a very quick scenario. It does not make sense if you invest and you're getting 10% on your investment, and at the same time you have credit card bills or you have debts that is at £20, 20% per annum, which means you're earning 10% on your investment, but you're actually losing 10% on your debts. So as much as possible, try and pay off your debts, credit card, especially credit card debts. Please, young people, I wish I could do just one session on credit cards alone. Yeah, please think very, very carefully before you go into credit cards, if at all. But even if you do go into credit cards, be very, very careful how you use it and how you pay it. It is the quickest, most compelling way of getting into debt and staying in debt. Please bear that in mind. Okay, so you have to understand what I mean by compounding. I'm going to come to you. Let me explain compounding to you now. The example where your mom gave you £1,000, mommy and daddy gave you £1,000 to say, you've done very well this year, I'm going to give you £1,000. You invested that money, and that year you will make £100. So how much do you have in total now? Anyone? How much do you have in total? Anybody? You can reach me by chat. Anybody? So you invested 1,000, you made £100 in profit. You have one. Thank you. You have 1,100. Now, you remember we said that you are now making 10% per annum on your investment. The £100 you made on the £1,000, that £100 was 10%. Compounding is the interest that you make on your interest. It is if you understand, and I'm going to ask you all as an assignment, because compounding is the most essential tool when it comes to investment. If you understand compounding, you understand how you can quickly make money. I'm going to ask you to go to a website. I'll give you the link. Read about compounding, and I need 3 or 4 people to come and present compounding to me with examples. Excuse me. So your mom gave you £1,000. You made £100 on top of it. You now have 1,100. Now, if you don't take the interest away, if you don't take the profits away for that year, and you now invest the entire 1,100 at 10%, what are you going to get the following year? Anybody? So now instead of 1,000, you've now invested the entire 1,100. So what do you get next year? Anyone? Thank you. You get 1,110. If you now invest, thank you Adonai, thank you Esther, thank you Georgiou. So the following year, now you're not taking the money. Now you are now going to invest that 1,110 for another 10%. What do you get? We're doing maths now, but it's basic math. Anyone? So you've invested 1,110 and you're going to get 10% of that. What do you get? Anyone? Okay, thank you. That is the interest. So effectively, what I'm trying to teach you as a concept, 1,220, that makes a lot of sense. So what I'm trying to teach you as a concept is this. Let me explain it to you. The interest, don't forget, you started with 1,000. All of a sudden, now you have 1,221. That is over 200% return on your investment. So people who are very, very disciplined when they do investment, they understand the principles of compounding. That's why I put very important next to this slide here. It is very important. Please understand the principle of compounding. Always live below your means. That's another very important one, please. Okay. And then try and spend an hour a week learning about personal finance. Okay, so we go to the next slide. What I want to do is, what I've actually taken you through is quite a lot. The time is about 4:39 now. Should we have a 5-minute break, everyone? Let me say yes in the chat group so I know whether should we have a 5-minute break? Yes. Okay. Any more people? Yeah. Okay. All right. So why don't we have a 5-minute break, and at 4:45 we're going to start all over again. Okay. So I'm going to pause the presentation at 4. Whilst you're away, what I quickly did, again, I'm going to share my screen now. You can see. I want to just show you an example of how quickly that 1,000 pounds can grow. So I'm going to share this screen, and I want you to just follow me. Let me see. Okay. Okay. Can everyone see? Let me see. Where's my chart? Sorry, I want to be able to see my chart. I can't see my chart. I use a lot. It's called calculatorsite.com. I'll send you a link to it. So that 1,000 pounds, if you put it like that, this is 1,000 pounds. Okay, it's in pounds, and the rate of return is 10% per annum. Okay, and if you leave it for 1 year, now this is the compounding interval. What the compounding interval means is how many times you're going to be given interest. Yeah. So it might be that you're getting 10% a year, but that 10% a year is not just going to give you at the end of the year. Maybe they're going to give you, over every month or every 2 months. Now you're going to see what the difference is. So, and you're not putting any more money every month. Let us see what you get. You're going to get, so we all knew that we're going to, so that's it. So you're going to get 1,104. Okay. Now, if we then say that you want that money and you keep it for 2 years, okay, at the same 10%, and we calculate it, that 1,000 pounds would have grown to 1,220.39. Now, this is the secret of compounding. Compounding, the secret to it is actually the amount of times that you get them to pay you interest. The amount of times that you get them to pay you interest. So using the same example now, let us see if we change that they're going to pay, so they're paying the money monthly. If we said that we're not going to keep the same amount of money for 3 years, yeah, and they're going to pay us the interest weekly. Don't forget, what we had before was 1,220. Yeah, it's still the same 1,000 pounds. It's still the same 3 years, but let's now see what that 1,000 pounds become. It becomes 1,349 instead of 1,300. So compounding is a very, very important concept when it comes to investing. So I'm going to stop sharing and we're going to go back to the slide. It's slightly more complex. I hope that if you want to find out more about compounding, I'm very happy. I'll send the link to it. Hopefully you'll be able to sort of try and have a better understanding. But it is a very, very absolutely important concept when it comes to investment. Let me share my screen again. Sorry, can't sharing. Excuse me. Okay, we're back to the slides. Thank you. Can everyone see my slides now? Okay. There's stock. When you buy stock, what you're doing is you're buying an ownership share in a publicly traded company. So, for example, you can't bring money to buy Apple anymore. Apple is already trading. It's an established business. But everybody knows that Apple seems to be doing very well. So one of the ways that you can invest, you say, look, I want to invest in Apple, or I want to invest in Facebook, or in GM, or IBM, or whatever, or Marks and Spencer's, or Morrison's. What you're doing by saying that you want to invest in them is that you are, in a way, demonstrating your you're saying that you trust the management. You're saying that you believe that that company is likely to grow and it's likely to become bigger. Now, what happens is the bigger a company becomes, the more money the company makes. And the more money the company makes, it means that the more money it has to share. That's basically the essence of what they call share. So that means that it's the more money it has to share to the people who hold units of its shares. So if you buy, typically what you do is you buy units of shares. Okay, shares are either traded publicly, like in big companies like Marks and Spencer's or IBM or whatever. They're on what we call the stock exchange. Okay, so you can open a share account. There are different companies that sort of sell that can help you to open a share account. When you open a share account, it's almost like opening a bank account, but you have to put money into it. You then say, I want to buy 10 units of Apple shares. Now, Apple shares at the moment is trading, I think, around about $1,500 per share. So if you want to buy 10 units of those shares, you're going to need $15,000. If you put $15,000 into it and you let it grow, you're watching Apple shares. If Apple then becomes a bigger company and it grows by 10%, it means that your shares would have grown from 15,000 to 16,500 within a shorter time. But I'm going to link it to risk later on, because there's a risk that as the shares could go high and go up, it can also come down. So one of the things that you have to bear in mind as an investor is that you have to have a medium to long-term view of investment instead of a day-to-day activity. There are different types of people who buy shares. There are those who are investors, and there are those who are traders. People who are investors are people who actually have a medium to long-term view of the market. People who are traders are people who go and every day they are looking at the stock prices of Apple or IBM and they want to quickly make money on a day-by-day basis. They are traders. They put the money in there. They have no intentions of keeping the money for a long time. They just want to make the money very quickly come out. Now, it's not a bad thing if you understand the market and use the right tool and you know exactly what you're looking for. To be able to do that, you need a lot more education on financial terms. You need to understand how to read company accounts and all of that stuff like that. You need to understand how to read the market. And also, there's a lot of things that affect businesses outside. So political, economic. We now have COVID. Whoever knew that COVID was going to happen last year? So if you had bought a share thinking that it was going to go up, I think almost every company, other than maybe one or two tech companies, almost all of them, like British Airways and so, they all went down. But does that mean that you should sell your stock? Not necessarily, because once this is all over, once COVID goes over, everything starts to build up again. That means you take a medium to long-term view of investment. Okay? So there's stock. The other thing that you can have is you can have bonds. The difference between a stock and a bond is that bonds are generally things that are issued not by small companies. They're normally by a government. If a company is issuing bonds, generally they issue bonds for specific capital projects. What I mean by capital project is they want to build a big warehouse. They want to develop a new car. They want to build massive machinery. So they want people to come and lend them money. So the difference between a share and a bond is that a bond is pretty much you are lending money to a body. In this case, you might lend money to a government. In the UK issues what they call treasury bonds. When the UK government, with this COVID, the government has been paying people's salary. Now, the government doesn't work. The only way that the government makes that money is it issues bonds. When it issues bonds, it's saying, hey, people, come and lend us money because we have a big thing we want to do here. So when you lend money to government, the thing is that governments are not likely to fail. That is the thing about bonds versus stock. The volatility or the risk that you carry with a bond is a lot lower than what you carry with a stock. With a bond, governments can very easily pay the money back. So so please understand the difference between the two. Then there's properties. Property is normally seen as a steady class of investment asset. Why? Because when you buy property, is normally for the long term. People who buy property for the short term are people who maybe buy, they renovate it and they sell it immediately. They don't hold it. But most people who buy properties, they buy them with a view to renting them out and keeping them for the long term. Okay. So with property, you make two types of money. One, you can make what they call ongoing passive income, which is rent. People pay you rent. The other one is you are hoping that if you buy in the right area, after 5 years or 10 years, the property value appreciates. And if it appreciates, you then sell the property. And on top of the monthly income that you receive, you also receive what we call a capital appreciation. You take that money as well. There are lots of examples you can get from that. Now, risk is very important when you do investment. The thing about risk is defined in financial terms as the chance that an outcome of your investment will be different from what you expected. So if I wanted to invest in a property, for example, thank you for the person who asked the question about whether an asset can decline in whether you can lose money on an asset. If I wanted to invest in a property, I have to look at the area where that property is. I have to look at how much they're looking to sell that property to me. I have to look at what the rental value of that property is in that area. I have to look at how easy and how quickly it will be to get tenants into that property. So these are all, we call them variables in investment. These variables all play together to help you form what is called your investment decision. Now, when you want to do your risk analysis, you say, okay, what if I don't get tenants quickly? What if, and that's what you call it, what if analysis in finance or investment. It's what if analysis. So if you can identify the risks, there's something that we call mitigation, okay? These are words that I put into the list of things for you to do. Mitigation is, if you identify a risk, you must also be able to, in your head, get an answer to that risk before you move forward. If you don't get the answer, it means that you have accepted that risk. And if anything happens, then it's a risk that you've accepted to go forward with. Please, I know it's a lot I'm going through, but these are the main concept of investment. Okay, so my own personal rule when it comes to investment, I'm sharing it with you. If I don't understand something, I do not invest in it. So what I'm trying to say to you is, before you go out there and say, I want to start investing, get good understanding and knowledge. Get somebody to sit down with you and explain it to you. What is this thing I'm trying to invest in? Where does the money come from? If you don't understand where the money is going to come from, then don't invest in it. Yeah? Investment education is essential. The same thing is avoiding investments you don't fully understand. If somebody comes to you with an investment opportunity in life, and this is not just when you're a teenager, in life, and they say, oh, I have this big investment, ask them to explain it to you. Then go away. Don't rush to decide it. Go away. Do your, what you call, due diligence. Due diligence is do your own finding, your own underground work. Then decide, okay? Okay, so basically, there are some core concepts I'm going to run through because of time. Basically, invest sensibly. Have a mixture of investment types in your portfolio. So don't just be somebody who invests in stocks and shares. And even if you invest in stocks and shares, don't invest in just one type of stock and share. Don't just put all your money in retail. You invest in Marks and Spencer's, Boots, Morrison's. If something happens to retail, you've lost. So invest in different of shares. Hospitality, maybe hotels and airlines. Invest in retail. Invest in different types, so that if something happens to one area, it doesn't affect the other area. That is where financial education comes into it. Then you can also have some bonds in your portfolio. Yeah, because it won't make you as much money very quickly, but it's steady. The thing with bonds is it is normally by good, solid companies or government. So the possibilities of government going bust or not being there is very, very low. They'll pay you 2%, 3%, 5%, but that is still good than 0%. And also, you might think of properties. Now, with properties, you can maybe group up with people and invest, or if you have enough money, or you can say to daddy and mommy, or you can say to daddy and mommy, daddy, mommy, if you are investing in property, I want to put some of my money in there. As it grows, then we can all grow together. Okay, so the other thing is get good investment education. I've just spoken to you about that. Start with simple investments. Okay, the most important thing is have an investment mind. Cultivate the habits of investment. The first thing, you remember, we said 3 things: make money, save money, keep money. Very, very important. Okay, incrementally expand your portfolio. Start as early as you can. Please don't say that you're too young to invest. Okay, I wish I was able to invest at your age. By the time you're 30, 40, 35, most of you should really be able to get to this. Actually, set yourself a goal. I want to have a house by the time I'm 25. Or, it's possible. It's really very possible. But that is a mindset that helps you to start thinking about investing. Then stick with it. Okay. I talked to you about ups and downs in investment. So long as you have a plan and it is clear and you understand the market, stick with that plan. Okay. When it goes down, don't just go and sell the investment. Understand what could happen. If you have a lot of people, so long as your asset class and your portfolio is diversified, it will come back together. Okay. Have a medium to long-term view of investing. Understand compounding. I've just explained that to you. If you can, try and get a finance or financial mentor. Go and find somebody who really understands. It might be mommy, daddy, daddy's friend, mommy's friend, or it might actually just be, speak to your mom and dad about, wanting to get somebody who can mentor you in finance. You know what? Education, you have a mentor, your teachers, they take you through that journey in school. Finance, most of you are going to grow up, and money is going to be one of the most essential things that you're going to have to be dealing with. Find somebody who can hold your hand and teach you how to make money, how to spend money or invest money, and how to spend money. Okay, so that is the final slide I have. I'm going to open the door, 5 minutes or thereabout, for questions. Anybody have any questions that you want to ask me? Put this into the chat. I'm going to try and answer them. Thank you. Any questions? Sir, are you able to pull out of bonds and investment free of cost, or will it cost you money to pull out? Look, people who provide a platform for you to trade, they also are invested. What they are doing is they've built a platform for you to be able to trade your shares and bonds on. They take a little bit of money in that. So some of them will charge you some money for when you invest, and they also charge you a bit of money when you take your money out. So there are lots, there are hundreds, maybe thousands of such platforms. So that's why I said you need to speak to your parents, please, or find somebody who can explain this thing to you in detail. Normally, there are some of them who are really good. They don't charge you when you buy; they charge you when you sell, and it's a percentage. Okay. How old do you have to be to open a share account? One of the things I'm going to share with you today is please go speak to mommy and daddy about ISAs. Yeah, there are some investment vehicles or investment types that they can invest your money in now, even at your age. They can open an ISA account on your behalf now. They can put money in there every month. Okay, so mommy and daddy can go speak to an investment advisor. They can. So there's no age limit. Even a newborn baby, I think, you can open an ISA for a newborn baby. If I could go back in time, what would I have invested in? Oh my good Lord! I'll tell you what, Joju. Oh my God, you guys are enjoying. I'm telling you, if I could go back in time, what I would have done differently, I would have not been buying. Let me not say I love cars, so I spend a lot of my money on cars, but that's fine. But I would have thought more carefully at your age. and maybe by the time between your age and when I am like 35, on what I spend my money on, I would have put money into properties. Okay, I would put money into properties. I would put money into into good company shares, not all companies, but good company shares with a very strong growth path. I would probably have put maybe money into bonds just to de-risk it, not to put too much risk into the baskets. But I would have really, the answer to your question is I would have been a lot more careful about how I spent my money. I said something to you earlier on. If you don't understand something, please don't invest in it. I'm not saying bitcoins are bad. I'm not saying that they are good. But there are certain assets, there are certain investments that are very, very volatile. Some people will put money in Bitcoin. Some bought Bitcoin when it was very high. They cried. They really cried. Some people bought Bitcoins when they were very low. There are people who put money, put $10, $20 into Bitcoin. Now I don't even know because I'm not a Bitcoin person. So this is actually one where Ms. Omole, I think we would.
Thank you so much, Mr. Yanibura. I'm sure everyone they've had a fantastic time. You've learned a lot. I have learned a lot, and so we've come to the end of today's session. The next and the last one continues next week.